Hey everyone, welcome to this week's Teaching Thursday. We're going to talk about a topic which is a metric known as volatility. It's also under a stock profile with the symbol beta, and that's actually going to be listed in our ebook Jumpstart Your Investments. But basically, volatility is just measuring the fluctuations of an actual stock or security. So your beta, a normal beta is going to be 1, and that's going to be equal to your S&P 500, which is pretty much the standard benchmark for all investments. So we'll say that this blue line here is the S&P 500, okay? And this is the normal trend over time. And so a beta, if it equals 1, that means that if the stock price has a beta of 1 and the S&P 500's beta is 1, which is actually the standard, then the stock price is moving consistently with the S&P 500 or the benchmark. Now, we're just using the S&P 500 for teaching purposes, but let's just go ahead and continue here. So if we have a stock and let's say the price is gradually increasing like this, same as the S&P 500, then this stock's beta would equal 1 because it's moving in the same fashion. But let's say that we had a stock and the stock price really wasn't changing like that. It was real small. It's increasing, but it's really small over time. Then it's actually going to have a beta that's less than 1 because it's not fluctuating as much as the benchmark is. Now, the benchmark has a steady decline, but this one is just relatively flat. So it's going, or it's increasing at a much smaller rate. So it's not prone to fluctuations such as the S&P 500 would or the benchmark would. Now, if we're going to talk about something with a beta that's going to be greater than 1, that particular stock is going to have more fluctuations. So if we take off this one, and if we have something that's kind of continually doing like this, coming down here, coming up, coming down here, coming up, whatever's going on, all of this up and down, and then coming down, going up, coming down, if you see particularly a lot of these, then this beta is actually going to be higher than 1 because there's so much action happening here. It's crazy what's going on. You can't really predict what's going to happen. With the benchmark, you can kind of predict where it's going, as well as with the beta that's less than 1, you can kind of predict. But if the beta is greater than 1, then you really don't know kind of how much fluctuation is happening. So if you have a beta that say is 0.8, then that means that it's 80% compared to the 100, or it's 20% less likely to fluctuate than the benchmark is. And if you have a beta of 1.2, then it's 120%, or it's 20% more likely to fluctuate than the market standard is. Now, another component that you want to factor into this is volume, which is also listed on a stock profile. And it's just going to have V. And so volume, it might be something like 2 million, okay? We're just using this as a random number. And so a volume is 2 million. And let's say that's the average volume, which we explained this in our ebook as well. So let's say that's the average volume. And let's say we have volume listed down here. So we'll just add V to the chart. And let's say volume is at a consistent line going across. This is the average of 2 million trades per day. That volume, it's going to relate with more so this type of beta because it's not fluctuating that much. It's steady at the 2 million. There's not too much more action going on. It's not too much less action going on. So the volatility isn't as increased. But if we have volume and it's something like, we got something here, then it spikes up, then it spikes down, then we got something here again, spikes up, spikes down, come back again, spikes up, spikes down, spikes up, spikes down, comes back, regular spikes down, spikes up. This volume is increasing constantly and it's always changing, so this is going to affect the volatility as well. For whatever reason, there's more action with this particular stock, and that's going to affect the volatility. Now, pertaining to your investment profile, and we actually have a risk assessment on our website. If you're a more conservative investor, you might be looking for something with a beta that's going to be equal to 1 or less than 1 because it's not going to be prone to as much fluctuation. But if you're more of a riskier investor or aggressive, then you might be looking for a beta that's going to be greater than 1 because that one has more of the big reward, big loss at the same time. So you're willing to lose a little bit in order to try to get that big payoff. So as an investor, that's something that you want to consider. You always want to look to see what the volatility of it is, and you can measure that with beta, whether if it's 1, which is equal with the market, greater than 1, which is fluctuating more than the market, or less than 1, which is fluctuating less than the market. And you can also factor in what the volume is. You can look to see what the average volume is as well as what the volume is for that day. Particularly around earnings times, you might see an average volume of 2 million, but around earnings time, for that particular company, the volume might be at 5 million, 6 million. That means that the volatility or beta is going to increase and then it's going to come back down probably after everything cools off. So that's in essence is what volatility is. Make sure you check that out. Everything on here was just for teaching purposes. We're not relating this to any particular company or particular stock. We're using the S&P as an example, but hopefully you get some idea of what volatility is and how to use beta in terms of your stock research, and if you're a conservative or an aggressive investor.